Imagine this specific moment. You co-founded a business with your spouse, or maybe they just recently joined a company that you started years before the wedding. And now you're sitting there wondering exactly what a DC judge would do with that business if your marriage were to end. The fear of losing control over the company you built or losing a significant stake in your life's work is incredibly real. Welcome to This Explainer. Today, we're covering exactly how DC courts classify, value, and divide a business between spouses, and what a prenuptial or postnuptial agreement can lock in before that question ever reaches a courtroom.
So let's address the most common questions entrepreneurial couples have. If you co-founded your business together during the marriage, does a DC court just automatically split it 50-50? Or if you started your business before you got married, does your spouse still get a share of it in a divorce? Well, the answers depend entirely on how you structure your legal agreements right now while you are actively building the company.
Here's our roadmap for today. We'll quickly cover the primary threat to your business, DC's equitable distribution rules, the concept of unpaid labor and sweat equity, a very common IRS tax status trap, how courts value a business, and finally, how to safely update your agreement after the wedding.
Section 1. The threat to your business, and why entrepreneurial marriages need specific protections. There were 5.2 million new business applications filed nationally in 2024 alone, and a lot of those new ventures involve married couples building something together. Building a company is already hard enough without constantly worrying about losing it. But the reality is this: if you and your partner launch a business without addressing it in a prenuptial agreement, you are handing a judge incredibly broad discretion over your company's future. With a significant number of marriages ending in divorce and about 20% of new businesses failing within 2 years, the overlap between business risk and marital risk is just too large to ignore. Moving to Section 2, DC equitable distribution rules and how DC courts actually classify property.
To answer that earlier question of whether a DC court will just split your co-founded business 50-50, we really have to understand the legal standard. DC follows equitable distribution, not community property. This means a judge divides marital property based on fairness factors, rather than just an automatic equal split. However, under this rule, a business co-founded by both spouses during the marriage is presumed to be fully marital property. That leaves neither side with a solid separate property argument. Now, this brings us to a really crucial point about businesses that were started before the wedding. A business owned before the marriage generally stays separate property. But DC courts draw a very strict line between passive and active appreciation. Passive appreciation, which is growth simply due to market trends, keeps that growth separate. But active appreciation, meaning growth in the company's value caused by one spouse's actual work or by using marital funds during the marriage, absolutely becomes marital property subject to division. Section 3. Unpaid labor and sweat equity, or when unpaid work becomes ownership. You might be wondering, what if your spouse never held a formal role or drew a salary at your company, but they worked in it for years completely unpaid? Can they still claim a piece of it? The answer is yes. When one spouse invests unpaid labor, like building out a website, managing social media, or handling the bookkeeping, they're creating sweat equity. Even without formal ownership on paper, this sweat equity creates a real equitable claim that a DC judge will absolutely factor into a property division analysis. To put the scale of this risk into perspective, consider a scenario where one spouse quits their job to help launch the other's startup, and they work unpaid for 3 full years. If that business reaches a $2 million valuation, that unpaid spouse has a powerful equitable claim. Unless a written agreement dictates otherwise, DC courts are going to listen to that claim. Let's look at Section 4, IRS, tax status, and ownership, which is essentially the qualified joint venture trap. Many couples choose to elect qualified joint venture status with the IRS to simplify their taxes as sole proprietors. But does that paperwork count as proof of ownership in a divorce? It certainly can. While this tax election might save you a few $100s in accounting fees, it treats both spouses as equal participants for federal tax purposes. It's a bit of a harsh irony. Trying to simplify your April tax return could accidentally cost you half your business in a divorce. If your tax return shows a 50-50 split, but your prenup states one spouse has 100% sole ownership, you've created a direct legal contradiction. That tax filing gives a non-owner spouse documentary evidence of co-ownership, unless your agreement specifically addresses this tax treatment. Section 5. Valuing your business in DC. How a court decides what the company is actually worth. If a divorce happens, the absolute biggest dispute is often how a court decides what your shared or separate business is financially worth.
DC courts and appraisers use 3 standard valuation methods: the income approach, the market approach, and the asset approach. Just as a quick aside, if you want the full breakdown of how these 3 valuation methods work, plus how 5 common business structures rank for divorce risk, the full article is linked in the first comment below. A strong prenup locks in exactly which of these methods will be used and sets the valuation date, which avoids an incredibly costly dispute later on.
Section 6, updating your agreement safely and modifying it after the wedding. So, what if you're already married, you never signed a prenup, and now you're worried about your business? You can still protect the business through a postnuptial agreement. A valid postnuptial modification in DC requires strict adherence to a few steps. First, it must be a written agreement signed by both spouses. Second, it has to be built on full and fair financial disclosure, so there are no hidden surprises. Execution has to be completely voluntary, meaning absolutely no coercion, and the terms themselves cannot be unconscionable or heavily one-sided. Finally, while not strictly mandatory, independent legal counsel for each spouse is strongly recommended to ensure a judge doesn't throw the document out later. The crucial point here is that you shouldn't wait for a marriage problem to update your agreement. Any of these 5 specific business events, starting a new company, receiving outside investment, a spouse joining the business, launching a joint venture, or hitting a major revenue milestone, should send you straight back to your attorney for a postnuptial review. The single takeaway from this explainer is this: a business built during a DC marriage stays dangerously exposed to division unless a written agreement defines its ownership split, the specific valuation method, and the buyout terms before a dispute ever starts. You simply cannot rely on handshake deals or assumptions. It's time to take control of your life's work. Will a judge decide your company's future, or will you? Check the first comment for the full list of triggering events we discussed today, and make sure to subscribe if you want more direct DC family law guidance for entrepreneurial couples without having to search for it every time. Thank you for joining me for this explainer.